Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending June 14th, 2019. I'm going to pick up where I left off last week, but before I do that, let me just point something out real quick on these charts to save me some time and you some headache. The symbols here, S&P 500, you can see the watermark here. The time frame up here is highlighted in blue, so this is W for weekly, and here are the moving averages or whatever indicators I might have on the chart, usually not many. So picking up from last week, I'll just back this up. We ended the week with a very strong gain, very strong price candle. Took out 3 weeks of downside. I think that was about a 4.4% gain for the S&P. And we came into this week as of last week's video. There was nothing wrong on the price charts. And here's what we look like on this week. So we have a little star up here. Most of the major averages gained about 0.5%. Most of the S&P sectors, the 11 sectors, gained roughly about the same, performed about the same. There was weakness in energy, industrials, semiconductors, and the best performing, and this is kind of interesting, was the defensive sectors. The 3 defensive sectors are rate-sensitive sectors. That would include consumer staples, utilities, and real estate, and the other 2 best performing were consumer discretionary. That was really supported by Amazon, and communications, which was supported by Facebook. And the reason I say this is interesting is because you do have more underperformance in energy, industrials, and semis, which are, growth sensitive, risk on sectors. And then the best performing was kind of a mix between the 3 most defensive sectors and 2 of the most risk sensitive as well, which would be consumer discretionary and communications. So that same tone was reflected here on the week. I'll zoom in a little bit. This is a weekly candle. So you can see the open and the close, other than this little gap up Monday, were virtually identical, very small range. This is a loss of momentum candle, a star. Let's take a look at the daily chart. And again, you can see it changed timeframes here to D daily highlighted in blue. And I'm going to just back this up to the start of the week. So here's how we opened on Monday, and we ended with a shooting star, a bearish shooting star here on Monday. So tone got a little bit uglier, just basically saying it's time for a rest. These are reversal candles, but they do need to be confirmed. The next day it was confirmed with a bearish engulfing candle. So opened here, closed lower here. These 2 days really look like deleveraging, really right from Monday morning. Not outright distribution and selling, but quiet deleveraging. And on Wednesday, just consolidation right here at the 50-day moving average, really not a reversal at all. And Thursday, the market got supported by crude oil after 2 tankers were attacked off the coast of Iran, and Friday just did nothing. This is a 15-minute chart of SPY. So here's the prior week's uptrend. That got broken here on Monday. You can see real bearish action from the open, and especially in NASDAQ right through Tuesday. And then we just did nothing the rest of the week, consolidated in a symmetrical triangle, tried to break out a little bit on Friday, but really didn't go anywhere. Here's the energy sector 15-minute chart, and I pointed this one out last week. This was the decline from May with crude oil just getting crushed. And last week it was trading in this kind of bearish flag pattern. It just stayed in there this week. It did get a bounce on the crude tankers being attacked and WTI crude prices soaring early Thursday morning, and just came down and still in that kind of flaggish consolidation. Here's XLI, the industrial sector. So it too did not look very good this week, but it didn't make any big moves in terms of price percentage. Let's zoom in a little bit closer. It's a 15-minute chart. I'm just going to come in a little bit. So here's Monday's open, just really bad price action, and Tuesday really ugly, and then it spent the rest of the week, like the rest of the market, in a consolidation. But this does have a bearish bias, as it is a bear flag, but it does have support right here around $75. So you can see it came down to that, put in this bear flag, and really didn't go any lower than that. So it does have that pretty decent level of support at 75, but I see a lot of these kind of flags that are still not really breaking trend, although this did break that trend from last week. An example of that might be crude or USO a little while back. Let me show you. I'm gonna have to jump out again, and you can see right now this was a bear flag also last week that I had pointed out. It broke down Monday here and Tuesday, and then Wednesday it got that bounce on basically oil tankers being attacked off the coast of Iran, and that creating geopolitical turmoil, and that's really why USO went up, but it didn't do anything here that negates what's going on. But it did hit, again, a support level here around 50.70 for WTI crude and around 10.50 here. or 1060 for USO. But getting back to what I want to show you, when crude started breaking this channel, first thing is a bear flag, but it was within this price channel. It broke below that and consolidated in kind of like a flaggish-like pattern right around it. That's kind of what industrials remind me of if this bear flag had been right on that channel. It gives them a little support. You don't usually see these big, sharp drops in this kind of scenario with some support around the area, but it may come down, consolidate a little bit more, then come down. So there's industrials, XLI again. And the other notable laggard was semiconductors, which I have kind of a longer term short position in. I'm not too worried about trading in and out of it. I think it's very mispriced, or has been mispriced. So here's semiconductors, SMH, on the week from here. So last week, again, a good week for semiconductors, maintain this uptrend. Coming into this week, selling off. And if I zoom in a little bit closer, you will see there's a bear flag here on Tuesday. It came right down to the measured move target here on Wednesday, broke trend from that prior week's uptrend, and has done nothing really. I'm not really going to call this a bear flag yet, but it's bear flag-ish. So those are the three sectors that really didn't look good. The rest of the sectors either had just absolutely no price action, kind of like the S&P in a triangle, symmetrical triangle like this. A couple that I liked, I mentioned a few that I liked earlier in the week. In the defensive sectors, actually have nicer consolidations. This is the real estate sector. Let me just back out so you can see what all this trend line noise is. Big uptrend here, and it's consolidating here and started to break out. This is one of two or three that I like, and that comes back to the whole mixed tone on the week where the defensive sectors are acting much better. Everything else is just killing time. Small caps were interesting this week. They went from some relative strength then to relative weakness. So I'll show you that real quick. It just kind of shows a little bit of the bias of the week. Go to IWM here, and I'm going to pull up relative strength against the SPY or the SPY. And I'm just going to back this up a little bit to last week. So last week I pointed this out. This was the May downtrend, and as you can see, IWM really wasn't doing anything, just going sideways here, but it was showing relative strength versus the S&P or the SPY, and that trend kind of turned down coming into this week where we kind of topped out or stopped in terms of momentum, and then it turned up again right here around Wednesday, Thursday, and then dipped back down. So this is kind of a little adventure. It's like relative strength here, relative weakness here, relative strength here, and now starting to come down to relative weakness. And it's very similar to what I see on 3C charts anyway. I showed you SPY last week. I'm going to show you again here. So this is a 1 minute chart of SPY. This is my own indicator 3C. So last week I showed in the video that the prior week's 4.4% gain over here had great confirmation. There were no problems on 3C charts. That started to fall off a little bit here with a small divergence, not a big deal as we came into the new week here last week, and a little bit of relative strength in 3C, nothing crazy, but right here around the low of that consolidation range of the past week. And Friday, it started to dip again, actually Thursday into Friday. So it started to look a little worse. The overall takeaway was that it's kind of flat, just like the price action, with a little bit of deterioration over here. If that gets worse next week, it may be a more actionable signal. But as I am going to get to in just a moment, there is some massive, massive uncertainty in the market into next week. One other thing I want to show you first before we get to that is kind of the tone deteriorating in some currencies, and specifically the Aussie versus the dollar, the Australian dollar. So here it is, AUDUSD, 60-minute chart. So this is actually a risk supportive trend. I love the Australian dollar versus the US dollar for macro kind of outlook on the market, inflation, deflation, growth expectations. But generally speaking, this is a risk supportive trend, and the market started bouncing, the S&P started bouncing after it had already put in a low and started trending up higher. This is how we closed off last week. I'm just going to step it forward coming into this week, and I kept mentioning to members, watch this 69.50 level right over here, because that's really where this trend is supported. So as we got into the week, it came down and tested right there, and then it broke. It was this break of the trend, a nasty bear flag starting early in the week, and that just led to a bunch more downside, a bunch more bearish trends, or flags, consolidations, and basically just wiped out the entirety of this supportive trend. So I'll put SPY or the S&P up against this because they trade different time frames. It's going to look funny, but you'll get the point. Actually, I'll use the Australian Dollar Trust because it trades the same hours. It'll look better. So here it is, the Australian Dollar Trust in orange and the S&P in the candlesticks, the red and green candlesticks. So again, this is the end of April where a lot of things were going haywire and saying, look, there's risk ahead, right before the trade war explosion in early May. The Australian dollar had already started to turn off. This is why I tell members, initially a small move, diverging, is really more sensitive to Asian risk assets, China, stuff like that. But when it gets really bad like this, it just kind of affects risk sentiment broadly. You can see it reflected a downturn in the S&P before it happened. It also reflected an upturn right here, the prior week's rally. And this week, you can see that whole decline I just showed you and wiped out all of this trend. As far as global growth or other growth-sensitive risk assets, don't forget, what crude did on the week, and I'll just show you here. I'll change this real quick to USO. So first, remember, it was trading in a flag, so it really didn't perform this prior week where the market did, and it's still not. It hasn't turned down below this support level, but if that turns down with the Aussie down, that's going to be very, very negative for risk sentiment or risk assets like stocks. So if you get the feeling that the market is kind of just going nowhere and has paused, as we see in the SPY this week, you're right. You're absolutely right. Why is that? That's because the Federal Reserve's FOMC policy meeting is coming up Wednesday of this week at 2 p.m. with a press conference at 2:30 p.m. So really quick, if I run through a couple different assets, we have the SPY sitting up here, just consolidating, waiting for more information. Here's a daily chart of SHI, the 1 to 3 year Treasury bond fund. It is torn higher this year, right? What is it doing? It's sitting up here consolidating too. Or if we go to TLT, doing the same thing, right? Consolidating. And if we look at gold looks a little bit messy here. Sorry about all the trend lines, but what is it doing? It's consolidating. You got risk assets, stocks sitting there consolidating, waiting for the Fed. Then you've got the safe havens like treasuries doing the same and gold doing the same. Even VIX volatility, while there's no relative strength this week, the overall trend continues to be higher, with VIX holding at its 50-day moving average. This is just a eclectic mix of kind of different opinions of either the Fed is going to cut or the Fed is not going to cut. This is the Fed dot plot. The blue dots are basically consensus of Fed members of where rates are going to be at various times, so 2019, 2020, 2021. And here's the current range, 2.25 to 2.5%. They're all in that range for 2019. They're slightly higher in 2020, 2021, and longer run. So this is basically saying that as of the March 20th meeting, the members that make up the FOMC, or Fed members, see interest rates or the Fed funds rate staying about the same or even going up slightly, and that's kind of what they've communicated with a patient bias. Now, what really changed in the last 2 weeks is the market's expectations of the Fed lowering or cutting interest rates. Here are the market-based probabilities of what the market is pricing in. So if you look at this blue line or teal, green, whatever it is here, that's the current rate, 2.25 to 2.5%. And for most of this year, it's just hovered in that area. You can see as we end May and come into June, that plunges. So the market is saying we expect the Fed to start cutting rates. The probability of a 25 basis point cut is here in the orange line. You can see that surges as we come into June. So of course, part of that is the trade war ramped up in May and the S&P plunged. Now, part of it is this prior week's real strength. Part of that, as I covered last week, was a short squeeze, CTAs going from 100% net short to 97% net long. And the biggest thing, really, in my opinion, was Jerome Powell, the Fed chair, on this same day, June 4th, saying that the Fed is ready to act. Now, he didn't say they're ready to cut rates. He just assured the market that if things turn south, the Fed is now ready to act. So it's kind of gone from patient, we'll see where it goes, to whatever it takes, we're ready to act, but we're not communicating a rate cut as of yet. The Fed implied probabilities are really rates go up a little bit based on the dot plot, and the market implied probabilities have been a rate cut, really priced in the end of May and right around that June 4th statement that he made. So next Wednesday is the FOMC meeting, and the market is pricing in that the Fed starts a rate cutting cycle. Now, the current expectations, market-based expectations, are a 25 basis point cut for next week. That's 23.3%. That came down from 30% earlier in the week because retail sales and industrial production on Friday came in stronger than expected. So good news was actually bad news for those who are looking for a rate cut. It actually brought the probabilities down a little bit, but still 23% is not very high. Generally, if it's above 50% and the Fed doesn't meet market expectations, you'll get a really nasty reaction in stocks. Now, the July probabilities for a 25 basis point cut are at 66%. So the market is really pricing in at least a 25 basis point cut in July. And for a 50 basis point cut, it's about 19%. That's down from 25% on Thursday. September, which is my own preferred month, or the month that I think they will actually cut, is 56% for a 50 basis point cut, at least 26% for a 25 basis point cut, and a 75 basis point cut is about 15%. So probabilities are very strong for September. They're pretty strong for July as well. But this meeting next week is really about what the Fed and Jerome Powell communicate to the market. Do they meet the market's lofty expectations that may be a little too high? I think the extent of the expected policy easing in the market is actually greater than the economic numbers would suggest, and certainly greater than the Fed's own dot plot. Another reason I favor September is because it's very unlikely the Fed is going to cut rates before they end QT, quantitative tightening, the balance sheet roll-off. So they may actually surprise the market and end it next week, which would be bullish for the market, depending on where their rate expectations go. Additionally, why I favor September is because the economic data is not that bad that it should suggest that the Fed cuts rates. There is a perception that they're kowtowing to political pressure. They might want to avoid that and wait to get in some hard data like Q2 GDP in July, the CPI report in August. There's also the G20 meeting coming up, possibly between Trump and Xi, and that is 28th through 29th of June. So they may want to see how that ends, how that turns out. And then there's an entire earnings season to report. So that's why I favor September. We'll have to watch what the probabilities do. But more importantly, next week, it's does the Fed communicate the same degree of policy easing that the market is now pricing in? If it doesn't, the market will react badly. If it does, the market should react well. And we have the balance sheet in there as well. This is basically why everything is in consolidation right now, from gold to treasuries to stocks this past week, to a lesser extent, even volatility. So there's a lot of opinions being expressed, but no certainty toward any one outcome, which is also why when we look at the SPY or the S&P 500 last week, it's just trading in this narrowing range of uncertainty. It's not willing to go down or reflecting that at this point. It did look uglier Monday and Tuesday. And it's not willing to run higher. As a matter of fact, this 2,900 level was tested 3 times this week, including in the overnight session, and was rejected. So prices weren't willing to go higher. They weren't moving much lower. The 3C charts reflect that same thing. And that is to say, not willing to go higher, seeing a little bit of taking off some risk here towards the top of the last week consolidation, and a little bit of support here down towards the bottom. Again, a little bit of weakening on Thursday and Friday. It's not something that I would jump on right away, but it is a little bit of a weaker tone. One thing you have to remember is stock charts don't tell you what's going on all the time and where your probabilities are. They tell you when you have a very high probability situation and low risk scenario. And that's where I personally like to act. So when I see something like this is telling me the market just doesn't know. Treasuries have uncertainty, gold has uncertainty, stocks have uncertainty. So you can make a bet on one way or the other. Does the Fed come in more dovish and the market soars, or do they not quite meet the really lofty expectations that have been priced in and the market drops? So you could probably have a pretty high probability, a pretty big move on a bet either way. But as far as I can see, there's no real objective data to take a long or short position here. One final comment is, as I touched on last week, this is the Fed funds rate. And you can see it's just been going downhill from 18% really, somewhere around there in 1980, down to 0% after the financial crisis. These gray bars are U.S. recessions. So what I want to point out is when the Fed funds goes from a rate hike cycle to a pause, as we saw here in 2000 and here in 2006, probabilities are very high that the next thing they're going to do is cut rates, but not only a little, but on a full rate cut cycle here. These are over 500 basis points of cuts. The Fed doesn't even have half that right now. And in the last two recessions, the recession started about 3 months after the first rate cut. Here, and here's the recession. Here's the recession. So the bulls are betting on kind of like a late 90s scenario where the Fed cuts a little bit and rescues the market for a couple of years, like 98, then came into 2000 and turned down lower. So this is what the bulls are betting on. That's just going to be a small rate cut, but the probabilities show over and over again, once the Fed starts cutting rates, it's a full rate cut cycle and we go into recession shortly after. That's a much higher probability, in my opinion, than what the Fed is going to do next week. And that's kind of where I am setting up my trades, not just recession, but taking advantage of the predictability of the Fed. So right now, this past week, the market has just gone limp. It's going sideways like a dead fish. There's little to no conviction on the part of buyers or sellers here. That's why we're going sideways in this tightening range, a triangle. And there's nothing wrong with this as far as the uptrend for the S&P the prior week. This is consolidation, but we're seeing uncertainty reflected everywhere in treasuries and bonds, in volatility the week before, and maybe we'll see something in the first couple days of next week that gives us an edge. But right now, I think what everything is screaming is we don't know. After that FOMC meeting and Powell's press conference, we could have some major moves either way, up or down. It really depends on whether or not the Fed meets the market's really lofty expectations that have been priced in since the end of May. So I'm going to leave it there. We will take a really close look on Monday and Tuesday into Wednesday, but Wednesday is really the big date, and then we have the G20 coming up at the end of the month, which will be just as eventful for the market. Have a great weekend, members. I will see you on Monday morning.